So every now and then I get messages from a social media platform. People ask me questions like, what is my portfolio worth? How many properties do I have? So what did I just purchase? Well, I purchased a new investment property at Bochum Hills, New South Wales. And how did I borrow 100% of the purchase price plus stamp duty? Well, I used equity for my unencumbered owner-occupied property. So therefore, I didn't have to fork out the 20% deposit plus stamp duty in cash. Okay, everybody, I don't normally do this, but guess what? I just purchased a new property. I'm Tony, and thanks for joining me on another episode of the Mortgage Chat. So every now and then I get messages from a social media platform. People ask me questions like, what is my portfolio worth? How many properties do I have? What are they worth? What's my net worth? What's my investment journey like? Am I buying this market? Or what's the best time to buy? What's my next game plan? What am I going to purchase next? Etc, etc, etc. So some of these questions I don't enjoy answering because I just don't like gloating about how many properties I have or what my net worth is, what's my property worth, etc. Right? You know, some of these financial advisors or buyers agents out there, I don't feel the need to tell you how many properties I have just so I can get your business. I'm not like one of those guys. Okay, I like to tell you what I can and cannot do for you guys, right? Because everyone's financial situation is a little bit more different, right? So just because it suits me and what I can do doesn't mean you're able to do it. And vice versa, okay? But some of these questions I don't mind answering, but as I said, they are subjective because what works for me may not work for you, and vice versa. But today, I want to tell you what I've just purchased, and I'm going to break it down for you in why I purchased this property, what future use I have for it, and I'm going to show you the cash flow on this property and how much it's costing me to sustain the property. So let's get cracking. So what did I just purchase? Well, I purchased a new investment property at Bochum Hills, New South Wales. I purchased a property for 2.05 million and I borrowed the whole amount, right? And I also borrowed for the stamp duty. So I'm all in for $2.15 million, which is quite scary. And how did I borrow 100% of the purchase price plus stamp duty? Well, I used equity for my unencumbered owner-occupied property. So therefore, I didn't have to fork out the 20% deposit plus stamp duty in cash, right? I was able to draw that equity out from my existing property and I can leverage it and purchase this investment property. So essentially, I borrowed the whole $2.15 million. So before you heavy investors out there jump on your high horse, yes, I know what you're saying. You're probably saying I could have purchased 3, 4, or 5 investment properties. That's going to be a lot more cheaper with better rental yield all around Australia. You are correct, but that doesn't suit my future plans, okay? I purchased this property because it allowed me to do multiple things on it in the future, especially in the next 4 or 5 years when my family gets a little bit bigger and we need a bigger place and closer to the school where I want to send my daughter. In the next 3, 4, 5 years, I'm going to treat it as an investment property and keep living in my own occupied property where I have no non-tax deductible debt on it. So why did I purchase this property and say I have multiple use for it? Well, the first thing was it had an older house on it which wasn't renovated, so it didn't have much value left on it. So if I knock it down, so the front house was an older house, it wasn't renovated, so it really didn't have much value left on it. But I do have a granny flat at the back, which probably was built maybe 3 or 4 years ago, okay? So that's why I really want to buy it because a lot of the houses around the area just had too much house value left on it, and I probably would have had to spend a lot more than $2.05 million to purchase the property, okay? And it was just a bit of a wastage for me to knock down a renovated house or a newer house in the future. This one didn't have much value left on it, which is why it suited my needs. But more importantly, it was in a good location that me and my family was happy with, that we were able to knock it down and rebuild a new house on it because it was north facing, it was quiet, it was on the high end of the road. But more importantly, if I didn't want to live in it and move somewhere else, I can do multiple things on it for investment purposes. The first thing is I can on-sell it if I don't want to live in the area in the next 3, 4, or 5 years. So there's a house at the front where a smaller family can live in, and there's a granny flat at the back. So in that particular area is very high demand where, you know, you might have a smaller family living at the front and your parents could be living at the back. So it's 2 separate areas. Or one can live at the front and they can rent the back out for rental income. Or I can develop it and knock down the front house and build a brand new house on it and on-sell it with the granny flat. The good thing is the granny flat has its own address and the front house has its own address. So if you're an investor that wants to buy a brand new home, well, you got 2 houses that's going to receive dual income. Or if you're going to buy the property for owner-occupied use, you can live in the front house and you can still lease out the back granny flat, okay? Because it's two separate addresses, two separate meters, so you can segregate everything. But what I can also do with the property is, once the New South Wales planning government relaxes the criteria for building duplexes, I can knock down the whole thing. I can build a pair of duplexes there and sell it to first home buyers or upgraders. And this is why from the start, I noted I had multiple uses for this property. I can either keep it, knock it down for owner occupied use, or I can develop it, unsell it, or sell it on as is. So now that I've told you why I purchased this property, I want to show you the breakdown on the cash flow from maintaining the loan. Now, the prices around the area is quite high and the rental yield is quite low. So I want to show you what it's like purchasing a property in Sydney with such a low rental yield. The good thing is I can sustain it because, like I said to you, I don't have any non-tax deductible debt. So sustaining the loan is a little bit easier for me. So if you're listening to this podcast, please just jump on YouTube and just look at this part of the video because it will show you the breakdown on Excel spreadsheet, how much it's costing me to hold on to this property. All right, everybody. So as you can see here, this is the cash flow from sustaining and maintaining the property. All right. So as I told you, I purchased this price and borrowed 100% of the purchase price plus cost, which is around $2.15 million. Okay. I purchased the property for $2.05 million and $100,000 was on stamp duty. And the rate here, 5.93. Now, this is just after the May rate cut, all right, which was passed on by the bank. I'm paying interest only, and that's my repayment per month, okay? So it's a bit scary right there, but you know what? It is what it is. Now, my rental income is $1,350 per week. So I've got a front house, which is a main residence, and I've got a granny flat at the back. So I've got dual income there, okay? Now, that's my gross rental income for the month. Now, I like to take out 30% as expenses, okay? So call it property management fee, insurances, water rates, council rates, whatever I call it. Sometimes it could be 20%, but I like to keep it at 30%, just be more conservative, okay? So my net rental income is just under $4,100, all right? Now, as you can see here at the bottom, my cash outlay is just above $6,500 per month. All right. So how did I get this? Is repayment minus my net rental yield. Okay. And one thing I accounted for this cash flow is the depreciation I can obtain back from this property. Right. So I've got a front dwelling, which is a bit old, but most of the depreciation came from the granny flat at the back. And I've got my mate Dual Tax, Twine, to hook me up for one. If you guys haven't used him before, please check him out. Okay, he's a very good guy, very good team, very smooth process. So I got this report back in, call it 3 days. All right. Now, so you can see here, my total loss for the year is $85,355, which is a combination of paper loss, $7,000, and my net cash outlay of $78,355. So obviously this loss I can claim back at the end of the financial year. Okay, so me and my wife's tax bracket for that amount is 37%. So 30% of that amount equates to $31,581. So this is the return I'm going to get back at the end of the financial year. Well, not me and my wife, 50-50 each, okay, because the property is purchased 50-50 under me and my wife as an ownership. So my real cash outlay is actually $85,355 minus $31,581.35 cents. All right. So my cash outlay is actually in paper value in real life is $53,773.65 cents. Okay. So per month it's just under $4,500, and per week it's just a little bit above $1,000. That's going to be cash outlay out of my own pocket. Now, normally I would consider this quite high. Okay, but because I don't have any non-tax deductible debt anymore and I don't have a loan against my owner-occupied home, I'm able to afford this quite easily. Okay, if I had a home loan still in my property and I'm paying, call it $4,000 a month, then yes, that's a different story. But because I have no more home loan left, it's easier to sustain for me. All right. So there you have it, everyone. So this is just a quick overview of my cash outlay for this particular property. So that was an example of the overall holding cost of sustaining that debt. But now I want to break it down a little bit more on the cash flow on the house only at the front and the cash flow on the granny flat itself, which helped with the cash flow. And this reverts back to the original granny flat strategy video I've done previously. So everybody, again, if you're listening to this podcast only, please just jump onto YouTube and watch this second part of the video. So guys, this is another reason why I believe a granny flat can help you with cash flow, right? So this links back to my other granny flat strategy video, okay? And I'll show you how this granny flat has helped with this property in particular. Now, for this particular property, I'm going to break this cash flow down to two parts. One of it is the front house, and the other part is the granny flat. Okay, so what I've done here is I've broken down the total cost of the two properties of the front house and the granny flat. Okay, so these are the two combined total costs of my purchase price plus cost, stamp duty, etc. So I'll just break it up into two. Okay, so on the depreciation report, it said that the granny flat cost about 220 grand to build. So I bumped it up to 240 to account for some stamp duty. Okay, so front house, I valued it at this amount with stamp duty, and the granny flat, I valued it at this amount. All right, so same thing as the last cash flow I showed you, but except I've just broken it down to two parts. Okay, the front house and the back house, which is the granny flat. So the front of the house actually got rented for $770. All right, so if I was to just account for that portion itself, my cash outlay is $7,102 if I didn't have a granny flat at the back. So now if you look at the granny flat itself, at $240,000 cost, at that rate of 5.93% interest only, the current property is actually rented for $580 per week. Okay, so you can see here, my total cost is actually lower than the rent received after expenses. So I'm positive cash flow on this granny flat itself by $573 per month. And this actually helps out the loss that I'm incurring on the front of the house. So as a whole, it's actually worked out quite good for me. And that's why I say to some people, sometimes if you're able to build a granny flat at the back for rental income, it's actually quite good because the rent you receive from the rental income outweighs the cost of sustaining the loan for that granny flat to be built. Okay, and this is a perfect example of it right here. Okay, everybody, that was the breakdown of my recent purchase in Sydney. I hope you liked this video. Please stay tuned. There's a couple more exciting videos in the coming months. So I hope to see you again in the next episode of the Mortgage Chat. Peace.